We've taken the decision to introduce a Japanese equity weighting across our portfolios, and in the process bring our overall equity weighting back up to sort of a neutral position relative to our benchmarks. In terms of putting a little bit more risk on the table, there were a few factors which influenced our decision. The first was seasonality. Historically, the fourth quarter, and particularly the November-December period, has been supportive for equity markets and risk assets generally. And with the volatility we've seen over the past 3 or 4 months and valuations having become a little bit more attractive, we think that sort of seasonal tailwind will persist into the end of the year. For about the 5th month in a row, I'm also going to mention US interest rates, and it's now probable rather than just possible that US interest rates will move higher following the Federal Reserve meeting of the 15th and 16th of December. Now there's 2 ways markets could react to that. It could be negatively, interest rates are going up, the party's over, we're all doomed. Or actually, markets could react positively. It's a return to normality. It's just a very small move, and particularly if policymakers at the same time indicate that rate rises will be sort of slow and gradual moving forward. And I think it was instructive that during September's or following September's meeting, when policymakers didn't move, and many expected them to, that markets reacted negatively to it. So we actually think when we get that interest rate rise, markets will almost breathe a sigh of relief, and we can also move on and start to assess other things. And really sort of the third factor was that there has been some stabilisation in terms of the global growth outlook. Certainly conditions in China appear to have stabilised. Manufacturing, which was behind much of the initial slowdown, again there are signs that the worst of the slowdown there has passed. So all other things being equal, the seasonality, the end of the uncertainty about the interest rate backdrop in the US and the global growth backdrop, all those things together we think will lead to markets pushing higher between now and the end of the year, and consequently we did want to just put a little bit more risk on the table. So that was the one decision, but why Japan? So we're very aware that the Japanese equity market has rallied significantly from its end of September low, but it does remain about 6% below where it peaked in August. And again, there are a number of drivers behind the decision to focus on Japan in particular. The first is really valuations. On a price to book ratio, Japanese stock market is trading at about 1.3 times. That compares to 1.7 in Germany, 1.9 in the UK, and 2.8 in the US. So clearly there's some valuation support there, and also in terms of the price earnings multiple. So a forward PE of 15.3 times isn't that demanding, and particularly given that the Japanese equity market is expected to deliver earnings growth of about 10% moving forward. So that was one factor. The other factor is the supportive monetary and fiscal backdrop. The Bank of Japan continues to print money, and there are views that actually the pace of monetary expansion may increase moving forward. There's a very stimulative fiscal environment. And again, given what we've seen in terms of the Japanese economy, growth is still quite slow, we think that support will have to remain in place. So there'll be a supportive liquidity backdrop. Currency, again, that there are more reasons to expect the yen to weaken moving forward, and that will help the Japanese exporting base. And again, the Japanese stock market has quite a large proportion of exporters within it. So again, that should be a tailwind. And also just cultural change. Japanese companies are generating large amounts of cash, and that is more cash than they are spending on capital expenditure. So the latest figures kind of indicate that the Japanese corporate sector is producing about $73 billion of excess cash per year. And increasingly that's being used to sort of fund share buybacks or increase dividend payouts, all of which is shareholder friendly. And again, Japanese management are increasingly accepting the need to make shareholder friendly moves. There has been that corporate governance change within Japan. Over 45% of listed Japanese companies have got cash on their balance sheet, which is far higher than we see in the US and Europe. So really, it was a combination of valuations, liquidity support, cultural and corporate change, which really sort of prompted us to increase that exposure to Japan. At this stage, we've just moved back to a neutral position. We're not going overweight at this moment in time, but really we felt that it was the right move to just take that underweight position off, both in terms of the Japanese market and equity weightings more generally.